Welcome to another edition of The Bull, the Bear, and You as we discuss what is happening in the markets and the economy and how it could affect how you invest. I'm Stacy Smith, and I thank you for joining us. And I'm pleased to have with me today Carrie Coghill of Coghill Investment Strategies. Carrie has been recognized numerous times for her expertise in the investment field. Frank Rossetti is retired from the investment firm that he founded, but he didn't take long to quickly find and found another firm called HF Management, which is an alternative investment firm. Kim Forrest is the founder of Boca Capital Partners, where she tracks and offers advice on stocks. You may have seen Kim in her many appearances on CNBC, Bloomberg, and also on Fox Business. Also joining us is Michael Godwin of Fregasso Financial Advisors. Michael is the Chief Investment Officer for Fregasso, which has been recognized nationally, and Michael's background is solidly founded from working in the pits to the Chief Investment Officer. I want to thank all of you again for joining me for Around the Table. Basically, it's Bull, the Bear, and You. And I have to ask, how's your summer going? Anybody?
Hot.
Hot.
Warm.
It's very hot.
And humid.
All right. And humid.
Yeah.
Yep. Well, since the last time we talked, the markets have continued their climb upward, setting new all-time highs. In the last 2 weeks, the Nasdaq has climbed nearly 4%. The S&P 500 is up nearly 3%, and the Dow is turning along, gaining 2.25%. And for the year, the results are even more remarkable, with the Nasdaq up 22.5%, the S&P 500 up nearly 18%, and the Dow up 6%, and closing on Friday above the 40,000 mark. So, Carrie, let's get your take right now on why the markets continue to climb and your reaction to comments by some contrarians that this is not sustainable.
Well, there's always contrarians. That's actually what makes the market. But, I think that there's legitimate reason why the market has gone up, and particularly some of the sectors. We've talked before about the Magnificent Seven and technology and the implications that technology and artificial intelligence will have going forward. So I do feel that the market performance has been confirmed by economic data. However, there are things that we're watching, and just in the last month or so, we've definitely started to see the employment market cool off. So it's really been employment that has driven our economy. We're 70% consumer driven. If people are working, the economy is going to do much better. We've started to see that cool off a bit. So the big question and the thing that we're watching is this going to continue to deteriorate, or are we just getting to a new equilibrium? Some of the contrarians that have been talking about, especially at the end of last week, we did see a sell-off with some of those big names. We saw a sell-off with kind of technology in general. And there was an article I read in the Wall Street Journal about, is the wave breaking? Is this all, all this artificial intelligence stuff has been blown up and it's not going to have the impact that it had? And I think that's whoever's really believes that. I don't think they truly understand the implications of what that sector of the market will do for us economically. So you always have to proceed with caution. And, as we head into the election, we're probably going to get a market that potentially could just kind of move sideways. I'm not super optimistic that stocks are going to, continue to run. The inflation data, believe it or not, is a little bit mixed. Last Thursday, we were super excited that inflation was cooling. And then Friday, we got a producer price index that showed, well, maybe this was just a pause. So, there's nothing major at this point. But unfortunately, those major things that happen that can drive a market down quickly are things that are usually off the radar.
Years ago, I saw.
You've been shaking your head.
Yeah, I agree largely with what Carrie's been saying. I do have a note of caution for AI investors, and I think it has this year, especially with the just complete growth of unfettered growth, there we go, of NVIDIA, it might disappoint investors in the short term because AI isn't necessarily coming to our, computers in meaningful, productive ways. And it's always been my note of caution about AI that I believe in it strongly, but it takes a very long time to develop productive applications, much to everyone's chagrin. Just because we can have computers doesn't necessarily mean we can do everything faster. So that's a note of caution. But I do see the push-pull of inflation, but I think the stock market is merited going higher because we can see a path towards growth sometime in the next, let's just call it 18 to 36 months, with perhaps some AI aids in productivity. But I think I heard this week that somebody was looking for AI to show up in this month's job numbers, which I think is completely crazy. But that just reinforces investors' extremely short timeline, especially where technology is concerned.
Stacy, I can
Frank,
remember
you were going to
back.
say something.
I'm trying to. Can you hear me? All right.
Yes, now we can.
The back in the 70s, when the market was a little high for some reason or other, I can't remember, the Forbes magazine had Paul Revere riding through the streets of Boston screaming, "The market's going to crash, the market's going to crash." That was, of course, satire. That will not happen. The market will crash and it will be unexpected. Crash, it'll go down. It'll be unexpected and it'll be a surprise. And after it happens, we'll know why. We don't know why now.
Okay.
I'll be very quick then, Stacy. I mean, you asked if it's sustainable. I don't think it's sustainable in the way that it's been going on this year. We have not had, as Carrie mentioned, a pullback at all of any recent, any magnitude whatsoever. You've hit to a point where the number of stocks that are outperforming the S&P 500 is at its lowest since 2000. So only a handful of stocks are outperforming the S&P and are driving the actual performance this year. And that's the big getting bigger. NVIDIA made up like 35% of the S&P 500's total returns through the first like 4 or 5 months of the year. So I think when you actually look under the hood, small caps were down in the second quarter, mid caps were down in the second quarter, international was negative in the second quarter. So you're starting to see the way the path is going, it's not sustainable. I think you need to see a broadening out of the overall equity markets for an upward path in the stock market to continue.
We recently just had the big banks start to report theirs. So how much influence do the financials have on the overall market, or is it just sector-wise?
A lot of it's the sector, but it does give you a glimpse into what economic activity is. And that's why I always like looking at the banks. And note each bank has its own superpower. Today is Monday, July 15th, and Goldman Sachs really hit it out of the park. But that's because, they're Goldman Sachs and they concentrate on certain areas. So don't necessarily look for your bank, especially if it's a small community bank, to be outperforming the way Goldman has. But it is, if you look at all of the bank earnings, showing us there's still commerce going on in a big way, although growth is kind of slowing.
Okay, we're going to have to take a break, but before we go, obviously over this past weekend, there was an assassination attempt on the presidential candidate, Donald Trump. On Monday morning, at least, the markets are all on the upside. Do these kind of events have much of an effect on the markets, especially something like this?
I don't think so. I'm going to jump in here because I've been a market watcher through some crazy cycles. Well, I guess everybody here has. What am I talking about? But I think it's way too early in the election cycle for the market to be commenting meaningfully on who's going to be president and what needs to change in your portfolio. Check back in October.
Okay, we will do that. And we have to take a break. We'll be back in just a moment. Welcome back to The Bull, the Bear, and You as we take a look at the economy and investing. Coming up this week are several economic reports, including retail sales, industrial production, and weekly jobless claims. So, Michael, How much weight do you put in these various economic reports, and are some more important than others?
Yeah, I'll try to be brief and let the others comment on this. I'm kind of fond of saying that nothing operates in a vacuum. So would you look at one of those reports and make a conclusion? Not necessarily. As Kerry pointed out earlier, one CPI number came in pretty strong, and the other one came in rather weak, and then where do you go from there? So everything, Stacy, in my opinion, is like a cog in a wheel, and you try to piece them together to get an overall view on where the economy is going and where the economy is heading. Some measures I do put more stock into than others. Industrial production, I look at that at the top line, and that's pretty much it. But I think right now the biggest things are, and Kerry pointed this out, is also employment. So that is, as employment starts to unemployment, I guess you should say, starts to tick up. That's something we really look into. So I do pay attention to the weekly jobless numbers. Inflation has been the biggest story of the markets over the past few years, and that's really going to impact what the Fed's going to be doing. So I do take a lot of stock into those CPI numbers, and you can see what happens when you get a decent CPI print, meaning inflation's cooling at a little bit of a more rapid pace than was initially forecast. Those smaller stocks really got a boost last week. The Russell 2000 drastically outperformed the S&P 500 because those are the stocks and the companies that are going to benefit more from rapid Fed rate cuts than probably the larger ones to an extent. So you got to kind of take them all, not one at a time, but look at them in conjunction with other economic data points and to form your thesis and your conclusions.
And what the
Yeah,
market's
it
telling
was
you.
interesting last week.
Go ahead, Kerry.
Carrie, go ahead.
I was going to say last week was really interesting because it really showed how fickle investors are. We received one inflation report that was slightly lower than expected, and everyone threw in the towel on the Magnificent Seven and ran into small caps and value stocks. And then the next day we get this other number, and they're like, "Oh, wait a second." And to that point, people were writing articles about it. As the party over, I'm like, it was one data point. Like now we're going to be all in on this. The party's over. It was, and the point about even watching the market at this point, because those stocks, those Magnificent Seven, have really overtaken the markets. And when we saw the market down at one point last week, negative, if you looked at the 500 stocks in the S&P, 498 of them were positive, but yet the overall index was down. So just like we've been seeing, these numbers on the upside with the S&P that aren't really real reflective of all 500 stocks, we're also getting it on the downside. So, individual investors that are doing it on their own really need to be careful. They need to be careful about what benchmarks they're watching and using, and how all this is playing out with the data.
I
Go ahead,
agree.
Frank. Oh, I'm sorry. Go ahead, Kim. You're ready.
Okay, so just real quick, the driving force really is technology. I just did some statistics for the portfolios that I run, and in the percentage that tech comprised from the beginning of the year till now increased by a lot. So at the beginning of the year, it was 28% was tech. Now it's 34% is tech. That is a huge move. And that tells you just about everything you need to know about where the market is hot. And, caveat emptor, we'll just say. Go ahead, Frank.
The market has been driven the last few years by interest rates. The anomaly was when they went up. First, the market went down, but then the market has written that off, and now it's been rising largely because of technology. These inflation numbers and these employment numbers are a precursor to a drop in interest rates. The Fed's difficulty on this is going to be in September when maybe they should cut interest rates. It will be deemed political if they do, and they don't want to be deemed political. And the risk that will come from them not doing it in time, and I'm not saying September's in time because there's a lot of data points that will come out between now and then, but based on these 1 or 2 points, September looks more likely than it had. Now, If they don't do it for political, because they don't want to be political, they risk doing it too late and pushing us into a recession. It's an interesting tightrope the Fed has to walk, and the market will reward lower interest rates no matter what happens, unless we actually go into a recession a meaningful recession.
Well, it's interesting you brought that up because I've been wondering whether when the Fed does finally decide to cut interest rates, whether it's already been baked in. We talked about this last week about, you buy the rumor and sell the news or vice versa, whatever it might be. Is there that potential when the Fed finally does say, okay, we're cutting it by 0.25%?
I
It
think
depends.
that first cut is, oh, go ahead.
No, go ahead, Kit.
Go,
I was
Frank.
going to say, yes.
No, please.
There's always potential for that. There's and I think we got a little bit of a taste of it in certain ways last week, because then, again, investors are fickle. We talk a good game about we want interest rates to go down. And then when the Fed acknowledges it, then investors are going to be like, oh my God, what do they know that I don't know? Maybe we are going into recession. So
Yeah, you can have that
But-
happen.
Well, I think what it is really too is so they do one cut and then investors go, well, where are they going? Right, exactly, Carrie. Are we going into a recession? Are we on the precipice of doom, right? So, and really, you can see this happening real time in markets. And you might think we're talking hyperbole, but this is kind of what you can hear from the markets. And people are pulled between fear and greed. So once those cuts begin, there's going to be a lot of chatter about when does it stop?
Yep.
And
Okay, I do want to bring up one other quick point here, and that is because Michael kind of indicated it, and then Carrie hit it as well, and that is if last week there was a point that the 498 of the S&P 500 stocks were up, but the index itself was down. Is there then a better indice for people just to take a look and see what really is happening in the markets?
it was 398.
Oh, 398. Okay.
What we do, the indice or the benchmark that individual investors should look at really has to be tailored to what their sector allocation is, right? If I have a client that is, because of risk tolerance and goals, is 60-40 mixed stocks bonds, then I need to create an index that is 60-40 stocks bonds. The other thing is, and we've been incorporating this a lot in our presentations, is to look at what we call the equal weight. So you can look at the S&P 500, which is market cap weighted, but there are also indexes out there that actually calculate it on an equal weight basis. So you're kind of smoothing those large, big market cap names out. And that gives us a better indication of where the economy is, where the markets are. But for us, benchmarks benchmarks are as personal as someone's overall plan.
Okay, we need to take a break. We'll be back in just a moment. Welcome back to The Bull, the Bear, and You as we take a look at the economy and investing. We've talked about this several years ago, but I'd like to bring it up, this subject again. So, Kim, you've given your client advice to buy a certain stock. It was perfect advice. The stock has performed maybe even better than you anticipated it performing. So, when that happens, have you set a target for that stock as to maybe when you might want to sell it and get out and take your profit, or do you just keep riding it until it comes down?
I'll answer this question, but I have to say this, that the way we run our business is we have complete discretion. So let's change the question. When I put a stock in someone's portfolio, what happens? So that's an excellent question, Stacy. And I'm going to give you, of course, either an economist's or an equity analyst's answer. It depends.
Okay.
So here's the thing. What I'm looking at is the holistic view of a stock about what it can do in the future. And my future is 3 to 5 years. In some cases, something almost miraculous can happen in a stock and it like doubles or triples or does some ridiculous thing, right? What I then have to do are two things is first to do risk reduction. If for some example, it's above 8% of someone's portfolio, listen to me, you investors that run your own thing, your own portfolios, you have now introduced a lot of risk into your portfolio. Because something is overweight, what happened on the way up can happen on the way down. So we, depending on your tax preference, we might trim a little bit of that back to a more manageable, maybe 6% position. Again, just trying to take those gains off. But it all depends. Like maybe that move means that the company has reached its peak potential and it ain't ever getting better than this. Then I would sell it, right? But it all has to do with what we believe the stock is capable of going into the future. And our future is long. So it's rare that we ever sell a stock because it has reached its peak potential. But, you know, I never want to say never. Isn't that the polite equity analyst way of saying, I don't know?
Kim brings up a good point. And first of all, Kim, congratulations on your perfect timing and your perfect execution on said stock that Stacy brought up. But we do run into the problem that Kim brought up, Stacy, quite a bit, where an investor, whether they worked at a company or they bought a stock 15 years ago and then they wrote it up and now they're either tied to it, whether it's emotionally or they think they have some sort of profound knowledge of what's going to happen to that stock going forward, and it's become a big part of their portfolio. And we ran into this a couple of times. You know, there's a large shoe manufacturer, shoe company that has had a rough year so far this year and had a pretty dismal report in earnings a couple of weeks ago, and that stock's down 35-40% so far in the year. And if it comprises 8 to 10% of your portfolio, that is a big hit. Mm-hmm. So that's one thing we really, really try to stress to our clients, where you've done a great job building wealth over the years. I mean, the number one goal is to not give it away, protect it. So take risk off the portfolio is not just a cliched term. It really, really matters here. And that's something we really work on doing for our clients. Even in a taxable situation, there's a lot of different options you have, options being a proverbial word there, to try to take some risk off the table without not taking on such a big tax hit.
So basically, if I'm understanding you correctly, and maybe what Kim is saying as well, is that if this stock has grown exponentially, that you want to trim it back, because otherwise it becomes too much of your portfolio. And then, if I understood you correctly, if it starts to go down, it's going to be a bigger hit than it would have been otherwise. Is that, am I
something
hearing
you definitely didn't plan for in that event? Right.
Yeah.
Right.
Okay.
Right.
See, and reaching back to the prior segment, with the indexes right now, the Standard Poor's 500 in particular, NVIDIA, I think, represents what, 5 or 10% of the whole thing, and 7 stocks represent 33% of the whole thing. They are overweight.
Yeah.
In a portfolio manager would be trimming those back. In an index, that doesn't happen. So the index is becoming the S&P 500 index has become a higher risk because of that overweight status of those positions. If they should sell off, that thing's going to look worse than it may be, just like it's looked better than it has been.
Mm-hmm. Yeah. Carrie, you want to wrap it up for us?
Sure. Yeah. I think that, this all comes back to the client, and there are definitely situations, to Kim and Michael's point, where you have to manage position size. The second thing is you also have to manage tax consequences, because the one thing people hate are taxes. And, as Michael was alluding to, there are strategies using option strategies, always looking for tax harvesting opportunities. But what I tell clients when we want to rebalance is that if we don't do this, you're going to have a much, much bigger tax problem. So you really put yourself into a corner when you let these positions grow in taxable accounts without managing the tax consequences along the way. The last thing I'll say is that the decision as to when to rebalance a position for us really lies with the client that we're dealing with, because we may have a client that's willing, if we really like a stock, and there are many out there that we like that have run, we'll really work within the client's risk tolerance. So we may trim it in one account and we may let it run in another account because you have two different risk profiles.
Okay, but that's a great segue into our next segment. I appreciate that. So we're going to take a quick break and we'll get into it in just a moment. And I'll give it to Michael. After our last segment, we indicated that maybe you're going to advise your client, maybe the time to get out of a particular stock, and your client says, no, I want to ride that. I'll ask this question to you, and that is the client always right?
Yeah, I heard Frank, so hopefully that went through. But I'll give a brief answer where I believe that the client is right a lot of the time. I always am fond of saying to the client that it is your money, it is not my money. We're trying to do what is best for you and in your best interest. A lot of the time, my job is to keep clients from being their own worst enemy and completely selling out of the markets at a time when they really shouldn't be. We try to stress the fact that it's a long-term plan. It's a long-term goals that we're trying to achieve. But in the end, it is your money. And if you can't sleep at night because of something going on in the market, then we need to revisit your allocation and maybe take some off the table. Some, not all. So again, my job is to try to make minor tweaks to a portfolio so a client becomes comfortable with how they're allocated in a given market environment, and make sure that it's not disrupting their long-term objectives and their long-term financial plans.
All right.
Yeah.
I think fear is an indicator that something's wrong. And it's either you or the way you're looking at the world. And that's, I think, the best way that you can look at any kind of problem is the person that I've hired, how different is their view of the world and where do we disagree? And if you can start there, this is a little metaphysical woo-woo stuff here, but I mean, that's really the problem, right? That if I'm saying, no, don't go out of the market, and you want to go to cash, you have to listen to everyone's reasons why, and then make the discussion from there. And by the way, how many people are asking to go to cash now when the market's going up?
True.
Nobody.
Very true. Carrie?
Stacy, what I'll say is that this is really a collaboration. You know, the way we work with our clients is that it is a collaboration. And just like Kim, we have full discretion over our accounts, and that's the only way that we work. But that doesn't mean that their input isn't important. It doesn't mean that how they're feeling isn't important. We assess their risk tolerance very methodically through different software. So if a client's going to come to us and say, I don't want to own something anymore, if I really feel compelled, you know, it's our job to explain our rationale. But at the end of the day, it is the client's money. And quite frankly, there's more than one way to do this business. So we're really trying to marry strategies with our client's risk tolerance. To Frank's point, there does come a time where it's either a match or where it's not. And we do everything that we can to try to explain and help our clients along. But that doesn't always mean that, you know, we're the right advisor for them.
Very true. Well, thank you for your input, all of you. We are out of time. I want to again thank Kim and Carrie and Michael and Frank for joining us for around the table of The Bull, the Bear, and You. And we hope that you join us again for our next edition. Thanks for joining us.